Hello, good afternoon. I hope you're well and your week is off to a good start. Okay, so just really quick from me. When I say quick, probably about 5 minutes. We've just had this really exciting opportunity come out, and I want to share this with you as my clients. Really high return. Of course, it comes with a little bit of risk associated, but 36.1% per annum in US dollars, 9.025% quarterly. Okay, so it's based on e-commerce giants. I think it's a really attractive opportunity, in my opinion. It's got a maximum of a 3-year term. So let me jump into it. Let me run you through it, and show you how this works. Okay, so this is come to us by Societe Generale. Okay, so you see them up here. They're the ones that put this together. Okay, and you'll see down the right-hand side here, this is based on Amazon, Alibaba, and Mercado Libre. So e-commerce giants. This is what we call a quarterly snowball. Okay, and what that means is the coupons are not paid out, the returns are accumulated and then paid out when conditions are met. And this is what we call a 170 with memory feature. Okay, so the way that this works, as always, it's based on the worst performing index. You would have heard me talk about this before. Okay, so I'll stick with green on this. So the note is going to start on the 10th of March. Okay, and what's going to happen is they're going to mark these three indices at 100%. Okay, so Societe Generale is going to do that, and then the note starts. Okay, so it's going to bounce up and down. Okay, and it might go like this for a little bit. Excuse the bad lines, till it eventually comes up here. Okay, so this is, of course, the worst performing index, and you'll see in this example, okay, the Q1 comes around, no coupon is paid. Q2, Q3, year one, Q1, 2, okay, until it eventually comes back above this line here. Okay, so at this point, okay, it's got 9 coupons accumulated. This is where the memory feature comes in. They're all back above 100. The worst performing stock is above 100, which means they're all back above 100. Okay, and this will pay out all the returns accumulated during this period. Okay, so in this example, based on a $50,000 investment, you're going to receive a total of 9 coupons. Okay, which is a 81.225% return on investment. Okay, and actually on a $50,000 investment, that's 40,612.50. Can't write the 50 US dollar return on a $50,000 investment, and that's after 2 years and 1 quarter. Now, there's one thing that I want to highlight to you, which is, if I can get this to work. Okay, let's just use a different color then. All right, so this has a feature where it can auto call. The name is in the title here. Okay, and that auto call feature kicks in from Q2. All right, so what happens is, let's say the stocks will do this. Come Q2, on an observation date, all the stocks are above 100% where they started. The note auto calls and it comes to an end. Okay, and that's going to pay you out 2 lots of 9.025%. All right, so this is a really attractive opportunity for people to invest in e-commerce giants. Okay, and just want to highlight through with you how that works. So looking at Amazon right now, okay, we've got 43 analysts out of 55 saying that Amazon is a buy stock right now. And you can see by the forecast, even if you take the median, it's expected to go in an upwards direction. Alibaba Group, okay, had a really volatile time, but again, 46 analysts saying it's a buy. Okay, and again, if you look at that median, okay, still looking to raise up proportionately over the next 12 months. And lastly, Mercado Libre. Okay, again, another buy stock. by the analysts and even on the median. Okay, it's still looking to increase. So just to refresh how that runs through. Okay, so on the 10th of March, SocGen or Associate General are going to mark where each of those stocks are at 100%. Okay, first quarter comes round, you're automatically going to accumulate 9.025%. When Q2 comes round, SocGen are going to look at where the stocks are. Are they above 100%? Yes. In which case, the note is going to auto call and you'll be paid out 2 times 9.025. And that process repeats every quarter after Q2, all the way up to the final valuation date, which is 3. It's got a 3-year term. Okay, and as long as none of the stocks have fallen by more than 30%, okay, you are going to get returned back your capital. All right, as I said, there is risk associated with it. So there's 2 risks. First of all, you might go 3 years without earning return if none of the stocks, if at any observation date all the stocks aren't above 100%, going to make no return. The second risk, of course, is if the stocks have fallen by more than 30%, capital's at risk on a 1-to-1 basis. Okay, so capital fallen by 40%, 40% of capital's at risk. Really excited about this. Highest return I've ever seen, 36.1% a year. It's unheard of. Again, appreciate that it's a bit different, something out there. Listen, I appreciate I've just run over this in really quick details, but please, if it's something that you want to learn more about, let's take half an hour. Let me talk you through it properly. Let me talk you through the details. But great opportunity right now for this coming year. Markets are going to recover, in my opinion. And e-commerce giants, bit of technology, tech, of course, is taking a battering. But it's definitely something that's going to be worthwhile investing into. Okay, cool. Thanks for your time and have a good week. And I look forward to hearing from you if it's something that you're interested in. All right, bye now.